Can we watch futures drop? They probably won't. They'll probably climb the rest of the way back up to 5170. But anyway, here we are, finding support on the lower trend. If PPI is hot tomorrow, it's gonna get wild, and we'll be here for it. Broad commodities moving up today. Yields kind of stabilizing a bit in the upper range. Saw them pull back at the end of the day on dollar finding a bit of resistance. Yields eventually did climb back higher than they were at the auction. So there's still a lot of short pressure on bonds there. I don't think there's any international things to worry about tonight. I think we're pretty much just going, we have some like stock inventory by foreigner shit and stuff in Japan, but nothing, no big prints. So pretty much just right into PPI and retail sales tomorrow morning. Retail sales is going to be really important. If retail sales is up, that's going to be strong for the dollar. But if retail sales is down and PPI is hot, they're going to kind of work against each other. So we could end up, I would say if that outcome occurs, we could end up with kind of a flat day where we get, like the dollar's down because of retail sales, but up because of inflationary pressure, right? And just kind of end up flat. Not ideal, but be aware of that. And that we'll have that information before market open. After market open, I think we have like business inventories and no big auctions tomorrow. Yeah, just inventories after market open. So we'll see. Hot PPI is a little more bearish, I think, than hot CPI. I think hot CPI is in fact bullish. Like the market reaction is bullish. And I think hot PPI, the market reaction is bearish. So if PPI is hot, 51.25. Depends on how hot, but I would say that bears are much better positioned for PPI than they were for CPI. So they did a better job today, holding positioning in place and building up their out of the money positioning instead of, building it up in the early part of the day because they got greedy and then getting squeezed out into close. So I think bears are a little better positioned for this, and I think bulls are a little worse positionally. Obviously, losing 75 into close is a big deal. It means there's less positive charm going into tomorrow. 70 as well. And then losing 50 on top of that, which we could if PPI is hot in the pre-market, would shift most of that charm in the bears' favor, and then all that would be left would be like 5100, which is probably the biggest strike anywhere near us right now. If we were to lose 5100, that would be very bearish. And then remember, a lot of that charm that's currently positive falls off Friday morning, with the rest of it falling off Friday afternoon. So going into Friday market open, things can get bearish anyway, regardless of where we close tomorrow. But the more bearish tomorrow, the more bearish Friday would be, I think. Anyway, so just an idea on that. I'll do like a bigger write-up. I want to check some shipping data and stuff, but I'll do a write-up tonight on PPI for tomorrow. So you guys have maybe a little bit better idea of where it's gonna land. I think I was pretty spot on with CPI again this month, right? Yeah, I was. So core dance, we're still seeing a lot of short vol, but a lot of this short vol has been pulling back. And overall, total, even though we're seeing a lot of short vol where it matters, right, in that VIX window, we're seeing total Vega exposure on the chain pull back quite a lot. So we continue to see Vega exposure on the reduce. We still got yields tightening. They beat the shit out of the forward yield on vol today. Although some of this, I believe, is the futures roll. This'll correct itself, but we're probably more like right here. Still, negative, but not as negative. Move, I'm not sure if that's printed yet, but I feel like bond vol should be up today. Skew yesterday pretty flat. Still about 80% of the S&P trading over its 20-day average, and a little bit of a bump here in VIX, cash VIX correlation. So I think yesterday we were around like 40.9. Today we're at 41.28. So still pushing short vol into the OPEX. What is super cool is we're now only pricing in 70 points of rate cuts, which means next week's FOMC meeting could be disastrous if they cut back on the rate cuts or their narrative is more hawkish. because we could price out fully 1 or 2 more cuts, which would be logical. Honestly, it wouldn't be bad. That would be better for our economy, because 3 cuts this year on rising inflation with a strong labor market's stupid. I know a lot of you guys had questions about BYND, so in an effort to not have you DM me all night, let me just touch on this real quick. Most of the day on BYND, we weren't really seeing any covering, but we were seeing upside, and this was largely driven by positive pressure on IWM. And then into the end of the day, we saw a bunch of covering and a big breakout, and this is what got everyone all excited. Largely, this is the effect of the 850 strike going in the money. As far as liquidity goes, there's still plenty more, right? If we look at periods where they've kind of maxed that out, we're very far away from that. They could still short this down more. It's harder because it's on reg show right now, but I would expect that any drop in IWM that opens up liquidity will open up an advantage for short sellers to get price down a little bit. Now, what does happen during these periods, because of this interchange with the positive, like the long calls and the covering over time, is that these positive price improvement days net higher and higher over time. And I talked about this kind of a bit on the weekend stream, but I'll cover it again for any of you guys that kind of missed this, is we're not really looking for like a big spike and a squeeze up to gamma max. What we're looking for is positive price improvement that incrementally, day over day, nets out to be, well, positive. And part of this is the effect of it being very hard to short the underlying, limited liquidity, and the interplay with long calls, right? And so when you hit long calls like we did today, you tend to get a big spike in buy pressure, and that creates, like, say 8% performance for today, right? And then say they short back tomorrow on a drop in IWM, well, maybe they only get like 5%. Right, and they've got to push up the borrow rate. They've got to hit those ETFs. They've got to get all that excess liquidity to drive the price back down. And because shorting is inefficient on a stock that is on reg show and in the middle of forced covering, you end up with the inefficiency benefiting the long side, right? And so, over 20 days of that, you might have like 30% positive price improvement total. And so eventually that'll push up into the levels where we have delta neutral and gamma neutral. And once we start pushing up into those levels, right, because the synthetic shorts are pushing, so we have both actually. So part of getting that liquidity to continue shorting forces the longer and longer calls, right? So the is becoming incrementally, as they get liquidity, they make the longer and longer calls. And so you get those flip points on the moving closer to spot, and you get spot moving closer to the and when they cross over, that's when you get the rest of your run, and that should blow out all the liquidity becomes very ample, and then they're able to get it off reg show and the cycle starts again. So I hope that helps you guys understand that a little bit and prevents you from asking me questions about it, because I don't want to answer them. Thank you guys all so much. I hope you have a lovely evening, and I will see you tomorrow. Goodbye.